Hello, my name is Michelle Singson, and I am the Manager of Tax Operations at EWM Tax Solutions. If you own investment property and are thinking about selling it and buying another property, you should know about 1031 non-taxable exchanges. A 1031 exchange gets its name from Section 1031 of the U.S. Internal Revenue Code, which allows you to avoid paying capital gains taxes when you sell an investment property and reinvest the proceeds from the sale in a property or properties of like kind and equal or greater value. This tax deferral is the main benefit of entering into this type of transaction, rather than simply selling one property and buying another. So what are the key points involved in undertaking this type of transaction? First, like-kind property is a broad term that refers to the nature or character of the property, but without regard to differences in use. For example, you can exchange an industrial property for a residential property. However, you could not exchange real estate for artwork. Next, it is important to note that any proceeds received from the sale of a property remain taxable if certain requirements are not met. If the seller takes possession of the proceeds, even temporarily, before completing the exchange for 1031 treatment, then they will have broken the rules. For this reason, proceeds from the sale must be transferred to a qualified intermediary rather than the seller of the property. Then, the qualified intermediary transfers the proceeds to the seller of the replacement property. The qualified intermediary is a person or company that basically facilitates the transaction and holds the funds until they can be transferred to the seller of the exchanged property. There is also a specific timeline that must be followed. You must identify the replacement property for the asset sold within 45 days, and then conclude the exchange within 180 days. Lastly, to get the maximum benefit from the 1031 exchange, the replacement property should be of equal or greater value. The reason for this is because if a replacement property is of lesser value than the property being sold, the difference is considered taxable. Although the 1031 provision is a great strategy to build wealth while deferring taxes, there are many complex, moving parts that require a good understanding of the complicated rules and limitations. If you would like additional information or would like to discuss if this would be a good option for you, please give us a call. Our team at EWM Tax Solutions would love to help you earn more, keep more, and live more. Thank you for watching. We look forward to hearing from you.